Well, hello, this is Hall Martin with the Investor Connect. Today we're with Duncan Davidson, the general partner at BullPen Capital. Duncan, thank you for joining us.
Howdy to all your Texas listeners.
Well, great. Well, thank you for being here today. Love to hear more about what you guys are doing at BullPen Capital and talk more about venture capital and funding in general. What is BullPen Capital about?
Well, let me start off by saying I was born in Texas. I love the Texas venture community. It's beginning to build up again. It sort of went away for a while. So I really applaud what you're doing, Hall, and I hope you can, just promote the Texas scene as much as you can. That's my lingering connection to Texas. My daughter-in-law is also from Texas, so we all have a warm spot for Texans here.
Well, that's
Okay.
great. Yeah. So we appreciate that and love to have you come back when you get a chance.
So, BullPen Capital, we were formed in late 2010, really a 2011 vintage fund. The perspective we had was you're trying to innovate in venture capital. So let me step your listeners back a little bit. If you go back, I did four startups, three of them around 1996 to 2001. In that era, you really had to raise 5 or 10 million in a Series A to see if you had anything. You had to go to the branded venture firms. You had to have a certain pedigree in order to get their attention. So I got venture funded two companies in the 90s that both went public, knock on woods. One in the early 2000s that was eventually bought. So I had to live through this period. The whole venture community has changed since then. The change really began in around 2005, 6, accelerated in 2007. The disruption was caused by what I'll call the era of cheap. So if it cost you 5 or 10 million to start a company in 1997, it cost you 500,000 in 2007. And some people are starting things today on $50,000. That is an incredible change in the dynamics of venture. One thing it did is it vastly opened up startups to new people. You didn't have to work at HP or Apple. You didn't have to have a pedigree. You could just launch something, and the effect of your launch in the mobile world or on the internet would give you the credibility to go raise money. The second thing that happened is the initial check dropped from this 5 million type of check down to 500,000 or less. And the amazing thing to us, the reason we started BullPen is we saw that the big venture funds, these Series A funds, legends in most cases, got bigger. And so by 2010, what used to be 1,000 of them was down to fewer than 100, and they all were really big, 400, 500, 600 million. They could not write a small check. This new wave of seed funds began to emerge, and they were writing the 500,000 to $1 million check. By now, 10 years after that sort of change started, what we see is the front end of venture capital is owned by this whole new breed of fund, so-called seed funds or micro VC. The classic Series A are actually relatively late stage. They want to write a much bigger check, and they often wait maybe 2 to 3 years after the formation of a startup before they put their money down. So with that with the background, we said, oh my gosh, this is a period we could innovate in venture capital. We see Paul Graham creating Y Combinator, inventing the accelerator, an amazing invention. We see Josh Koppelman out of Philadelphia starting First Round Capital, really the model of a modern seed fund. And we said, we want to innovate. So BullPen Capital defines something we call post-seed. Our insight is all these accelerators and seed funds are going to fund you up to $1 million, $1.5 million, but usually not far enough along to get a $10 million, $15 million check from the big venture funds. So we have created this thing that's $3 or $4 million. We call it post-seed. You might think of it as a classic small A round, but it's in between seed and the big funds. And so BullPen, by doing this, has created a new category, and we really are the leader in the category, and we get unbelievably strong deal flow. So I'll pause for a moment, but that's why we started BullPen.
Well, that's great because we see the rise of the micro VC fund, $25, $50 million funds out there doing the very, very early stage work. Is that exactly where you guys go, or what's unique about BullPen compared to other micro VCs?
Well, we wait. We don't do the seed round. We don't do what's now even pre-seed. It's sort of funny. Seed has become so aggressive that there's a new category, pre-seed before seed. You got to love this world. We wait until the company is showing product market fit. Usually it's about 1.5 years old. Usually it's got somewhere around $1 million of recurring revenue if it's a SaaS or enterprise play, and a little bit more than that if it's a marketplace play. And we'll typically invest in around the 3 to 4 million. It tends to be in the low teens in valuation. And we set up a follow-on round. Our last 6 follow-on rounds have run an average of 15 million on an average of 45 pre. So we're kind of the setup between the seed stage. If you get into our category and we fund you, we have a very high success rate for you to graduate and raise this 15 on 45 type of round, and then you're off to the races.
That's a pretty big jump. How much do you put in on the seed or early stage funding side of it versus the later stage?
Again, our rounds tend to be 3 to 4 million. We would
Okay.
put in around half, so 1.5 million to two of it. And then
Okay.
we'd expect the earlier investors to load up on the rest of it. In fact, we want them to load up. We want them to say to us, my gosh, we want you to lead this round so we can put more in. It's an indication that they really believe in the company they funded at the seed stage.
And what kind of products are you actually, or sectors are you actually focusing on these days?
Well, that's fascinating. When we started doing this, it was all the trend back then. So we for example, one of our companies is the first Android venture funded app. Everybody was doing iPhone. We helped fund the first Android version of this stuff. So we did a lot of consumer apps and iPhone, Android apps back then. But as the wave has moved forward, we've seen a transition of the type of companies that we invest in. We did a lot of SaaS way back when, much fewer SaaS deals today because we're not seeing the same quality of SaaS coming up. What we're finding is really interesting now are marketplaces. You could also think of on-demand services. We love them because if you get an advantage in the marketplace, you have an effect, a moat against other people challenging you, and you can become a very big company once you get past the initial stages. Another thing we're funding is what I'll call frontier tech. And so frontier tech, it's always what's out there in the future. We just funded a 3D printing company doing carbon fiber in a unique way. We funded several IoT companies. So we're also funding the next generation stuff as it comes in.
That's quite a range you got there for what you're funding. How do you keep up with all the different technologies, especially the frontier tech where it's still emerging?
Well, what we do, we actually think of ourselves as a stage and not a category. In other words, a lot of venture funds say we do SaaS and we're really good at it, or we might do VR, AR. We don't think of the world that way. We think if the company's emerging into our stage, this post-seed stage, they can show metrics. We don't really care where the CEO came from or the founding team, but we can tell how good they are by how they performed in the first year and a half or 2 years of the company. And what we want to see is they have trajectory coming through our stage to get the big check in the next round. So to that extent, we're less concerned about the subject matter. One of the funniest things we do, we have a post on our website which gets a lot of people amused, which is, no, I don't want to see your demo. Early stage company, they all want to show you the demo, how cool the
Yeah.
technology is. And we say, look, we're assuming it's great. It has to be pretty good or you wouldn't be showing the revenues. Let's talk business. Let's not talk technology. To that extent, we're a strange animal in the venture field. Most people fall in love with the tech. We actually want to love the business and assume the tech was just done well by the right people.
Well, it's a common mistake by entrepreneurs. They treat the investor as a customer and try to sell them the product. 90% is on the demo or what the product does, and only 10% is on the rest of the business. And we spend our time trying to flip that around the other way as best we can. But it sounds like what are the metrics you're using for determining they have product market fit or they're getting into a place that you can get interested? What are the key metrics that you focus on?
I would say the insight we came up with early on is to reverse engineer the metrics. So what I mean by that is we watch the market of the 10, 12, $15 million round after us. Now, I have a very good sense in certain categories like consumer marketplaces or SaaS or some consumer apps. I have a really good idea of what it has to look like about a year after our investment to get that 10, 12, or $15 million check from the big guys. So we then work back. We work back like a year earlier. At this point in time, do you have the growth rate, the metrics, and the core business structure so that we're pretty confident a year out, bam, you'll get the next big round. So we reverse engineer it because it changes. The market changes. We actually noticed SaaS. I could just pick on SaaS for a minute. About 5 or 6 years ago in the public market, SaaS was selling something